Have you ever wondered what would happen if the biggest holder of your country's debt started selling it off? Well, that's exactly what's happening right now. For decades, China has been the United States' largest foreign creditor, buying up trillions of dollars in U.S. Treasury bonds. It was a comfortable, symbiotic relationship. The U.S. got the cash it needed to fund its government, and China got a safe place to park its massive foreign exchange reserves. But the tides are turning. China is quietly but steadily dumping its U.S. debt, and the numbers are staggering. So let's rewind a bit. How did we even get here? Back in the early 2000s, as China's economy exploded, it started accumulating huge amounts of U.S. dollars from its export boom. Instead of just letting this cash sit there, Beijing decided to invest it in what was considered the safest asset on the planet: U.S. Treasury bonds. This move served two purposes. It helped keep the value of its own currency, the yuan, low, making Chinese exports cheaper and more competitive. And it provided a stable, low-risk return on its investment. By 2013, China's holdings peaked at a mind-boggling $1.32 trillion. It was a financial marriage of convenience that defined the global economic landscape for years. But that peak in 2013 was the turning point. Since then, we've seen a slow but consistent decline. Fast forward to today, and China's holdings have plummeted to their lowest levels in over a decade, dropping below the $800 billion mark. We're talking about a reduction of over $500 billion. This isn't just a minor portfolio adjustment, it's a significant strategic shift. For the first time in years, Japan has overtaken China as the largest foreign holder of U.S. debt. This sell-off isn't happening in the shadows either. The data from the U.S. Treasury Department is public, and it paints a very clear picture. China is systematically reducing its exposure to the U.S. dollar. So the big question is, why? Why would China sell off what's long been considered the world's safest investment? The answer is complex, a mix of economics and geopolitics. First, there's the ongoing trade and tech war. The relationship between Washington and Beijing has become increasingly tense. The U.S. has used financial sanctions against other countries, and there's a growing fear in China that its massive holdings of U.S. debt could be used as a political weapon against it. Think about it. If your rival holds your financial lifeline, you'd want to untangle yourself, right? This process is often called de-dollarization, and it's a key part of China's strategy to reduce its reliance on the U.S. financial system. Another major reason is purely economic. The U.S. Federal Reserve has been aggressively raising interest rates to fight inflation. When interest rates go up, the value of existing bonds with lower rates goes down. So, China is likely selling off older bonds to avoid further losses as U.S. rates climb. It's a pragmatic move to protect the value of its assets. Plus, China needs capital for its own domestic priorities, like propping up its struggling real estate market and funding ambitious projects like the Belt and Road Initiative. Selling U.S. bonds frees up that cash to be used elsewhere. What does this mean for the United States and the rest of the world? Well, when a major buyer like China steps away from the market, it can create upward pressure on U.S. interest rates. There's less demand for Treasury bonds. The U.S. government might have to offer higher interest rates to attract new buyers. Higher rates mean it costs more for the government to borrow money, which could lead to a larger national debt. For the average American, this could translate to higher borrowing costs for mortgages, car loans, and credit cards. On a global scale, it signals a potential shift in the balance of financial power. The U.S. dollar has been the world's dominant reserve currency for nearly a century. But this move by China could be one of the first major cracks in that dominance. So if China is selling us debt, where is all that money going? It's not just sitting in a bank account. China is actively diversifying its investments. A huge chunk of it is going into gold. For months on end, China's central bank has been on a gold buying spree, adding hundreds of tons to its reserves. Gold is seen as a universal safe haven asset that isn't controlled by any single country. It's a classic hedge against geopolitical risk and currency devaluation. Beyond gold, China is also investing more in the currencies of its major trading partners and in international organizations. It's also promoting the use of its own currency, the yuan, in global trade, especially in energy deals with countries like Russia and Saudi Arabia. It's a slow, methodical effort to build an alternative financial ecosystem that isn't centered around the US dollar. In conclusion, China's massive sell-off of US debt is more than just a financial headline. It's a reflection of a changing world. It's driven by a desire for financial independence, a reaction to geopolitical tensions, and smart economic calculations. While it doesn't mean the US dollar will collapse overnight, it is a clear signal that the unipolar moment of American financial dominance is being challenged. We are witnessing a strategic decoupling, a slow-motion shift in the global economic order that will have profound consequences for years to come. The world is becoming more multipolar, and the flow of money is starting to reflect that new reality. What happens next is uncertain. But one thing is for sure: the cozy financial relationship between the US and China is officially over. Thanks so much for watching. If you found this breakdown interesting, please hit that like button and subscribe for more deep dives into the forces shaping our world. See you in the next one.